In this video, we will see why the Magnificent 7 stocks are dropping more than the overall market, the overall S&P 500. In this video, I want to cover a few points from Terry Smith, Fundsmith, and their latest letter, so you will understand why. And I have the proof of what I'm saying. We will compare the S&P 500 compared to the Magnificent 7. These are the two charts, so we will play around with some numbers. Okay, let's start with the letter, 2024 letter of Fundsmith. Terry Smith is one of the best UK stock investors, and I think he delivered a great letter for 2024. In case you didn't read it, you have some performance metrics, you have his a few words about the market, and he also talks about the rise of index funds, because the reason why all these Magnificent 7 stocks, the Teslas of the world, Google, Amazon, Nvidia, the reason why they drop so much is because they're weighing in the S&P 500, their allocation is huge. So you will understand why. Let me read some text a little bit, it will be more clear for you. Okay, the rise of index funds. In late 2023, passive investment via index funds exceeded the amount of assets held in active funds for the first time. They are now more than half of assets under management, AUM. The vast majority of index funds are market cap weighted, like the indices on which they are based. The size of holdings in companies in the index fund is based upon the market value compared with the market value of the index. Apple is very big, it has a large allocation into the calculation of the S&P 500. Another company that can be much smaller has a tiny percent, a tiny allocation in the S&P 500. So when there are inflows in index funds, the largest portion goes to the largest companies, and vice versa when there are outflows. Imagine you have Nvidia that is quite big, Microsoft quite big, Apple quite big. So if you have new inflows coming from investment funds of the world, more wealth effects, so a lot of more institutions are buying the S&P 500, Vanguards or anything related to the S&P. When you have inflows of money, people that want to buy the S&P 500, it will go to many companies in the US, 500 key companies, but in majority to the Magnificent 7, because these stocks represent the majority of the S&P 500. Big tech is the US market right now. You can say whatever you want, big tech is driving this market. The Apple, Microsoft, Nvidia, Meta platforms, Google, Amazon, these kind of stuff. So if you have more inflows, these stocks will go up even more. And this is what has happened. I'm taking this example, Round Hill Magnificent 7 ETF, that started, when did it start? A little bit before 2024. Let me zoom out a little bit. This Magnificent, maybe the starting point is because we started to call these names the Magnificent 7. So April 2024, in candles here in green and red, you see the Magnificent 7 basket, so the 7 biggest stock. And in purple here, you see the S&P 500. You see that when the market goes up, when the S&P 500 goes up, the Mag 7 stocks, this basket goes up even more, like at double the rate. If you remember 2023, 2024, the Magnificent 7 drove all the earnings, all the gains from this market. And when there is a decline, this Magnificent 7 decline much more. And then we enter 2024, and if you look at 2024, let me just put the starting point here at the left of the screen, okay? You see that when the S&P 500 goes up a little bit, the Magnificent 7 goes up by much more. This is exactly what Terry Smith is saying. Same thing all year long for 2024. And he also says that you also have the reverse situation, vice versa, when there are outflows. When the S&P 500 is going down, when you have people selling, when you have outflows, the Magnificent 7 are getting crushed. and they rebound more sharply, and this is exactly what we have at the moment. So let me continue with the letter, and then we'll talk about this market in 2025. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The result is that as money flows out of active funds into index funds, as it has been the case for so many years now, it drives the performance of the largest companies, which are companies whose shares have already performed well, which is how they became to be the largest companies by market value. Yes, Microsoft is big, so Microsoft has a big allocation in the index. As we have more inflows in the index, a lot of new money is getting invested into Microsoft, so the market capitalization of Microsoft is going up. So Microsoft's company as a market cap is bigger, and because it's bigger, it takes an even bigger percentage of allocation in the index. So as we have more inflows of money, it drives this cycle. You have this virtuous cycle of growing and growing and growing, and it has been the case for so many years. This is the reason why we have such a concentration into tech for the S&P 500. This is a self-reinforcing feedback loop which will operate until it doesn't. For example, were there to be an economic downturn which led to a reduction in tech spending, for example, which is now so large a proportion of overall spending that it cannot be non-cyclical. One era of vulnerability might be spending on AI, as it is not currently generating much revenue. I mean, this letter was released at the beginning of January, but it's very true today. There are some worries because of DeepSeek, because of all the AI growth phase. There are some worries that maybe there is a probability that the capex investment towards AI will be reduced in case we have a recession in 2025 for some reason. Maybe they will slow down a little bit on the capex for AI. If this is the case, the tech industry will be affected a lot. Where the largest companies then to produce disappointing results, their share prices are likely to react badly, which will drag down the index performance much more than that of those active managers who are underweight in these sectors. Yeah, if you are not investing in tech, you will not suffer as much for good reasons. But even if some scenario like this awaits us in the future, what exactly will cause this and when it may occur is difficult or impossible to predict. Obviously, this is completely impossible. What Terry Smith is saying here is that when the world is going well and the earnings are going up and we have more investments and everything is fine, the S&P 500 will go up and the Magnificent 7 basket will go up by much more. But if for some reason the index goes down because of a downturn, because of uncertainties, because of a trade war, because of some reason we have a market correction, which is happening right now, the Magnificent 7 basket will drop significantly. And with this pad, it seems like I have some difficulties zooming in and zooming out. So let me do my best here. Let me do my best. This is what we have at the moment. So if I start 2025, here is what we have. At the left of the document, at the chart, you have the beginning of 2025. You see that the S&P 500 is almost flat. This is the line in purple, dropping a little bit, like a 3% drop, as we can see at the right of the screen here. But the Magnificent 7 is dropping by much more. It's in a correction territory, minus 14%. And this will be pretty easy to see if you look at the rear view mirror. At the end of 2025, we will all say that it is obvious, but at the moment, as of March 2025, it is not obvious at all if we will have a rebound shortly in this index. Seems like this is a downtrend at the moment, but no real change for these companies. If you look at the Magnificent 7, at the moment, they all have good revenue growth, earnings growth, and capex is really big, and maybe they will reduce the capex. The thesis has not really changed. What has changed is the sentiment, and we all know how it works, right? Sentiment drives the whole market, and we also know that price drives the narrative. Now the Magnificent 7 basket is down 15%. People say, oh yeah, this is a bad investment. Google, Amazon, I will wait until they get cut in half and then I will invest. Most of the time it doesn't happen. Most of the time they don't drop 15%, 50%. So the recommendation is to do the DCF, do the valuation process, a good framework, and you buy them when you think they are cheap. But I think all the gains since October evaporated for the Magnificent 7. And if I go back to a couple of months before, the last time we reached this level, the oldest time was in July. So we have 6 months, even more, 7, 8 months of stock market gains completely evaporated. That will be good. That will be good to monitor. And I can even compare this drop that we are having right now with the drop we had in August. And if you look at the Magnificent 7, you are looking at this. I hope that's big enough for you guys. I don't. If you look at this drop here, you had a 22% drop from the peak to the bottom of this downtrend. And if you look at now, what do we have? As of today, from all-time highs for the Magnificent 7, we are at, yeah, this is fairly right, minus 20%, minus 21%. So if you are panicking right now, please don't. This is normal. We had exactly the same thing happening 6 months ago, 8 months ago in August. I see a lot of people panicking over YouTube, Twitter, etc. The reasons of the panic are the same. I remember that in August, people were panicking about the Japanese carry trade that for some reason spooked investors because interest rates in Japan were higher, going higher, and then you have a carry trade phenomenon. 2 weeks after this, people had already forgotten. 2 months after this, people really didn't care. And I wouldn't be surprised if for some reason we have a rebound now, because the companies are fine for the moment. If you look at the Max 7, they are fine. I wouldn't be surprised if for some reason in a couple of days you have an upswing, more volatility, and people will quickly forget. So what is that, by the way, at the bottom? You have volume, more volume. You can expect more volatility because of the new presidency in the US. You can expect more volume. You can expect the VIX to go up. That's fine. I know what I will do at least. I will stay invested. I don't plan to sell anything. I don't plan to panic sell right now. That would be a mistake because I still own good companies. What matters if you really want to invest in the long term is to hold on to great companies that you believe have a strong potential for the future. If you hold, for example, Meta platforms right now, Facebook, and you believe they have a strong future for the next 2, 3, 5 years, do you really sell Meta platforms now? If you look at the stock price of Meta platforms at the beginning of the year, they had a tremendous run. Yeah, they had like 20 years in a row of green, and all this run of 20 days in a row of green evaporated. Look at this, up, down. So frankly, we are down to where we were 2 months ago. No big deal. No big deal. Frankly, I see no reason to panic over there. This is pretty healthy. The market will have some pullbacks. It's normal for the market to have several pullback periods, maybe 2 per year, 3 pullbacks per year. That's fine. And this is the first one for 2025. And because of all the uncertainties, trade war, maybe you can expect a second one. Maybe you can expect a third one. You will have swings of 10%. This is the life of the stock market. If you joined the S&P, if you joined the investing train in 2024, 2024 was a special year because we didn't have a lot of volatility. You all only had April and August when the S&P 500 went down, but that quickly recovered. You can expect something else for 2025. Nobody knows the future. Maybe we will drop 20% and then back up. Maybe back 15%, 15%, back up a little bit and then down a little bit. Nobody knows. Don't trust anybody who I mean, a lot of people will say they have a crystal ball and guesstimate where the market will be. The market is high. Don't be delusional. The markets are pretty high right now. The valuations are pretty high. You have to be really cautious. You have to know what you invest in. You have to know what you buy, do the work, do the valuation. But if you have a clear framework, I don't frankly worry. So this is the daily advice for you guys. Don't panic over this drop. This is almost nothing happening. We are back to where we were a couple of months ago. No panic here. And now you understand why you have such a big downtrend for the Magnificent 7. If the S&P 500 goes down a little bit, these big tech companies will go down a lot more. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.